Hello and welcome to our latest investment update as of June 11th, 2020. I'm Mark McCarron, Wescott's Chief Investment Officer. And in today's edition, we're going to talk a little bit about the market update, a little bit about our economic outlook, and we're going to continue our conversation from last week, which was about the actions you can take during market volatility. And then finally, we'll end with an updated outlook given the current environment in both the economy and the markets. So first, a market update. The news this week was that the Federal Reserve Chairman yesterday came out and committed to keeping rates very, very low all the way through 2022 and would provide more support if needed. The initial reaction was positive, although current markets, today's markets, are a little bit more volatile because the uncertainty with respect to what's happening with the economy and the impact of the lockdowns continues to be unknown. But the Federal Reserve's commitment to low rates does provide some stability and some support for both the economy and the financial markets. The other piece of news that came out this past week was that initial jobless claims continued to decline, but of course they remain elevated. This is important because really what's going to bring the economy back to life is going back to work and making sure that consumers have the money and start spending again without fear. And that isn't quite here yet. So that's why we think there's going to be continued uncertainty and a bit of volatility in the market. And then the final thing we'd like to highlight is the upcoming U.S. presidential election. It's not going to be happening, obviously, until November. But as we approach November, it's our view that markets are going to be able to begin to price in certain scenarios, and that will bring with it uncertainty. And given the uncertainty that comes along with presidential elections, we will be discussing that in future webinars. So let's take a quick look at the market update through June 11th. As we talked a lot about this before in our previous webinars, the broad recovery has been strong in the second quarter of 2020. The S&P 500 index, up through yesterday anyway, erased losses for the year, although today's markets are down. NASDAQ 100, which represents large technology, healthcare companies, is in fact in positive territory this year after a steep decline in the first quarter, a very strong recovery, and is up well over 10%. And finally, the market in general, broad market, and we're looking at the S&P 500 equal weighting here on the orange line, that's also recovered, which indicates that it's not just the technology, not just the healthcare, but a broad-based recovery, albeit uncertainty remains and volatility is still with us. And it's really that theme we want to focus on in last week's webinar and also this week's webinar. So what other actions can one take during market volatility? And as a reminder, we had some actions last week, and we'd encourage you to go back and listen in to the webinar we did last week, which talked about first, how you can upgrade the quality of your portfolio, perhaps be opportunistic in identifying good opportunities that are priced better. The other things we can do during volatility is being tax smart and also reviewing risk tolerance. So those were covered last week. This week, we'd like to talk more about what you can do in terms of actions and more on the behavior side. For example, number one, resisting the urge to sell, specifically during the most down days or the most volatile days. And we're going to talk a little bit more about the dangers of doing that. The second thing we'd like to highlight is that to remember that bull markets are more common and tend to last much longer than bear markets. And that's a good thing for long-term return. The third is to review your portfolio to ensure it's diversified properly. And if it's not, making sure that you adjust it so that the portfolios have components that do well during periods of volatility and do well during periods of recovery. And that's really what Wescott is doing in the portfolios for all clients. The fourth is to rely on the financial plan that you have in place because it already incorporates periods of market volatility. And we're going to go into more detail later in the presentation. And then finally, rebalance. So rebalancing is really a critical risk control component. So when there's market volatility, you're able to readjust portfolios, bring you back to target, and effectively that allows you to sell positions that are performing well, selling high, and buying positions that are underperforming currently, but potentially could outperform in the future, and that's buying low. And doing that allows you to take full advantage of a recovery like we've had so far in the second quarter. So let's look at some of these in a little more detail. So the first is resisting the urge to sell, particularly during the worst periods of the market. And because reacting can hurt performance. So this shows the performance of the S&P 500 from 1990 to 2019. And the first bar shows that the return over that time frame, the annualized compound return, was 9.9%. That includes good days and bad days. But if you were to sell out after a bad day and miss the best day during that period, your return automatically goes down. In this case, goes down by 40 basis points or 0.4% a year. But if you were to miss a week, even 15 days, or even 25 days, the best days, and we've had some of those best days during this period of volatility, then the return expectation goes way down, and you really lose the benefit of investing in the stock market. So, the summary here is that missing only a few days of strong returns can drastically impact overall performance. So the other key point we wanted to highlight is that you have to remember that bull markets tend to last longer and be much more powerful than bear markets. And what we're showing here is a history of market ups and downs. And by the way, these graphs and charts and history and the data we're using from Dimensional Fund Advisors, which is a partner of Wescott's for over 25 years. So what we're showing here is the S&P 500 return from 1926 to 2019, quite a long time frame. And what we're doing is we're showing the periods of time when a bear market occurs, which is defined as a 20% decline in the S&P. And we're showing those here on the bottom part of the graph. But what's apparent when I look at this history is that the bull markets, which are in the blue, tend to last longer. In this case, 167 months, and is up over 800% in the cumulative. And the most recent, just to bring it up to date, 130 months and 451% return are far outweighing the periods of time where the market does fall 20% or more, but typically for shorter time periods, and the recovery is quite strong. So it's important to remember the history, very importantly, because that keeps us focused on the long term and keeps clients invested in the market. Again, fully benefiting from the long-term return opportunities that equities provide. And then finally, relying on the plan. So what we're showing here is the market's response after a crisis. And what we're showing here is the light blue is 1 year after the crisis, the yellow is 3 years after the crisis, and the darker blue is 5 years after the crisis. So let's look back at some previous periods of volatility in the US stock market. For example, October 1987, a stock market crash that many people remember. 1 year later, the stock market was, this is actually a balanced portfolio. So what we're looking at here is not just the S&P, but a balanced portfolio that already considers diversification. A balanced portfolio return would be 19% higher 1 year later after that October 1987 crash, 33% higher 3 years later, and 76% higher on a cumulative basis 5 years later. And we can look at other periods of uncertainty, other periods of volatility. In fact, September 2008, the bankruptcy of Lehman Brothers and the ensuing credit crisis. 1 year later, you're in positive territory, and 5 years later, you're up quite strongly on a 60-40 balanced portfolio. So what we're really highlighting here is that there are many actions you can take during periods of volatility. Resisting the urge to sell during the worst days keeps you in the market. Remembering that bull markets are typically longer, stronger, and more powerful than bear markets. And finally, relying on the plan. Relying on the plan is critical because Wescott and your advisor have already incorporated periods of volatility into that plan. And if you have any questions regarding that, we encourage you to contact your Wescott advisor, which was, again, another action you can take during periods of volatility. To finish up our current outlook, we continue to pay attention to the economic policies that are very, very accommodative, very supportive, and we believe that they will, over time, continue to support both the markets and the underlying economy. However, growing economic and political uncertainty will have and continue to have the potential to drive volatility. And that's really why we wanted to highlight some of these things last week and this week. And finally, the market behavior that we're seeing in the market, that recovery, very strong from the lows in March, can deviate from economic realities. And it really does stress and underline the importance of having a disciplined approach, which we believe can add value over time. So as always, thank you very much for your interest, for joining us today, and the confidence you have in Wescott. Please do not hesitate to contact me or your advisor if you have any questions. Thank you.